Hey, Aubrey.
Hello. Hi, Dave. I see you're attending. We have
Uh,
people trickling in already. I can see the attendee list might be hidden from you.
oh, I think I need to swap my background.
See it?
That? No.
Yeah,
Or like this.
that's working. He's a
Okay.
CFO. He's not a tech guy.
I figured it out.
Just teasing.
I figured it.
Hello, everyone trickling in.
I'm just gonna.
So, Steve, while we're getting started here, it is January 31st. You work with a lot of accounting teams. Is this like a day of celebration that so much of the year-end close stuff is coming to an end?
It's a battle. Like so, in some clients we're like just about done.
Uh-huh.
And we're ready to start our financial audits and get the audits going, and
Hmm.
we have good trial balances, but we need we need a few little entries left to make them final. But yeah,
Yeah.
it's kind of coming down to the wire. I mean, it's 1099s, it's W2s. It's trying to get all that stuff done and filed for the clients and on time,
Yeah.
with penalties. And so yeah, it was a very busy month, let's just say that.
Yeah. Yeah. I can see that too, the 31st. Now it's down to the wire. So maybe tomorrow will be a brighter day.
Yeah, we can celebrate starting
So
tomorrow.
celebrate tomorrow.
Yeah, and we're preparing for the big storm, right? We're down in Southern Cal, and it's like, it's a beautiful day, but it's gonna change,
I
it's
know, I saw that too.
10-foot waves, like
Yes.
starting
I went
tomorrow.
I went for a walk on the beach this morning and there was like 100 surfers probably in the same spot.
Oh yeah, are the waves
Yeah.
big? Are they starting to grow? Or usually it's not supposed to hit till tomorrow, but or tonight,
Yeah,
late.
there were some pretty big waves. They came in sets, so it wasn't super choppy, but yeah,
Look at
that's
you,
fun.
surfer girl sets. Do you surf?
No, I wipe out.
I used to, like, back in the day, like, I'm dating myself, but I body surfed. And I know people do that today, but body surfing is what I enjoy. My
Mhm.
body's a surfboard.
That's all you need. Matt,
Hey
Hi,
guys,
hey Matt, how's it
hey.
going, bud?
I'm not used to the green screen.
I
Do you have
know.
a green screen? For me, it's just
Well, I think he means
No,
just
I don't
having a
actually
bougie
have.
background.
ah,
There you go. Are
like,
we off? It's 12:30. Are we moving forward here?
Yeah, we're ready to go. We have people trickling in. We have about 35 people in here right now, so
Awesome.
we can get started.
All right. Well, let's go ahead and get started. We like to start these things on time and end on time. Welcome everyone to our TGG Bonfire Chat, the first one of 2024, and very excited to kick this off because just like me, I'm sure most of you or many of you are thinking about taxes. It's end of year, start of a new year. Hopefully, you got the business plan moving, but you're starting to get your stuff together and get it to the CPAs, and all kinds of things are going on. So we wanted to make sure as CFOs, not as CPAs, but as CFOs, we really inform you as to some of the things that are important that are coming up that you need to be aware of. We had a whole bunch of tax law changes over the last 5 or 6 years. Some of them that we thought were going to stay around have been done away with. Others will expire here in the next year. Some will expire in 2 years. We're going to talk about all that. And then there's been a bunch of tax law changes and things that we think that you ought to be aware of that you can take advantage of today to lower your tax burden. My goal for you all today is that you take away something that you can do. something that you can make sure you're taking away, something that makes you money. And that is Steve and I's goal today. So without further ado, I want to welcome Mr. Steve Birnbaum to the webinar. Steve is a longtime CFO, one of my favorite people on the planet, and we're really excited to have him here because he is both technical and communicative. So we've got the opportunity here to dive into a lot of the technical stuff, but also not have someone tell us something that is like flying over my head. So, excited about that. The other thing that I just want to remind everybody who's in there, please send any questions you have in the chat. They will come directly to me and Aubrey, and we will make sure to moderate those and get those to Steve as necessary. We want this to be an interactive experience. We don't want your questions to go unanswered. If for some reason it doesn't get immediately answered, they will be answered by the end, where we do have an additional Q&A section at the end here that we'll make sure we talk about. So what are we going to talk about today? Well, we're going to start this here with some of the tax provisions that we had out of the old Trump regime in 2017. There have been some that have already sunsetted and gone away. There have been some that are going to go away in 2025 and everything in between. So can you talk to me a little bit? Give me a refresher, Steve, on what happened with that, just so that we can remember back to what happened and where are we going to end up potentially?
Yeah, thanks, Matt, really for the introduction and for the kind words, and welcome everybody. Yeah, so really the tax benefits from the Tax Cuts and Job Act that was passed in 2017 expire in 2025, at the end of 2025. A lot of them do, but unless Congress acts to extend them, they're gonna what we call sunset or expire. So some of those things that there were huge tax benefits for everyone during those years. Income tax rates were reduced from like in the mid 30s to low 20s. There were the personal exemptions were increased. Capital gains were lowered to 15 to 25%. So if you're thinking about selling your business, you might want to think about doing so before they expire, to take advantage of the lower capital gains rates. That's one planning tip to think about.
Steve, you talk about things expiring. Talk to me a little bit about what's expiring and when, because I think this is something that I know I'm concerned about here, because it does have a planning impact.
Yeah, I mean, like for example, the estate tax exemption is a big thing to avoid gift and inheritance taxes. It starts to step down from 25 million exemption in 2023 for estates down to 13 million in 2024 and 7 million in 2025. And any like estates over that are taxed at 50%. So 25 million, 13 million, 7 million from 23, 24, 25. It's vital that businesses start thinking about succession planning, trusts, bequeathing, assets, the net worth of the business to your heirs. There's all kinds of things that we can help with, that we can help direct your CPA tax professional to think about in terms of planning for, especially just for that one topic alone. It's massive. So that's some, most of them are expiring in 2025, Matt, but this step down stuff, there's phase out depreciation for bonus depreciation is phasing out from 23 to 27. You've got the qualified, business deduction opportunity zone deferral that ends after 2026. But most of this stuff is expired in 2025. And in fact, the R&D tax credit already expired in 2022. And we know how that impacted.
So I want to put a pin in the R&D tax credit and come back to that, because I've already gotten a few questions about Section 174 and is it coming back and all these other things. But I want to go back to the estate tax for just a second. Because I was just on a call a few days ago with a business owner talking about whether or not there's two issues for me. One is obviously these exemption amounts are coming down. So your amount that you can pass tax-free is going down and eventually could really be eliminated depending on who's in the White House, et cetera. But I think we've got to really start to think about And this was the crux conversation that I was having with these folks was, how much is enough for the kids? How much is enough for us? How do we navigate this stuff? Because clearly, if we want to take advantage of gifting, we need to do it now, and get those business interests out of our estate so we don't pay estate tax on them. But I struggle with the more practical questions of, is this the right thing to do for me? How do you approach that with your clients?
Well, I mean, you really want to understand the net worth of the business, the book value. You may want to get an enterprise value, sorry, a 409A valuation, to really understand the value of the business. But you should know the book value based on if you have good books and records, right? The net book value of your business. But you really want to make sure that you're thinking about what are the client's goals. We talked about the client, what's most important to them. Do they want to sell? Do they want to keep control? Do they want to, pass it on? Are they moving? What kind of succession planning do they have in place? There's all kinds of questions that I would ask business owners and CEOs in terms of where are you headed? And then we see whether, how we wrap this stuff around these phase outs of these big exemptions for the estate tax exemption.
Yeah,
Do they
I
have a trust? Do they
I
have
found ourselves in a very interesting conversation around this, because it's really, you lose. Look, if the exemption amount goes from 25 million to 13 million, that's a loss of 12 million, which 50% of it's going to be, you lose $6 million in tax that your family will have to pay. But the offsetting is, how do I keep control? And so I would encourage people to really work with their CPA and an estate tax professional. Now, our CFOs have a lot of experience with this, Steve, but I think you've got to go back to your CPA and maybe an estate tax attorney to really think through. There are a lot of mechanisms to retain control and to gift things out. And that's ultimately what we decided to do with this particular individual. And it was really helpful to understand that you can retain control and take advantage of the gifting. So it's not like you just got to put it off and cross your fingers and hope it goes.
I guess I would say, Matt, we would be the partner, so that when they talk to the tax CPA and the attorney, we're side by side with the client and helping them navigate, making sure the right questions are being asked, right? They're not being killed in terms of fees and stuff to do this, but they're, so that we're helping them through it as their partner to make sure it's done effectively, accurately, for the least amount of cost and the lowest tax burden possible. That's what I would do, right, with the business owners that I work with.
No, I think that's another good one. Another good point. So let's talk a little bit. You said another thing that just kind of slipped by me, but I took a note here. I mean, I am taking notes on these things, and it was about 100% bonus depreciation phased out starting in 2023. So it started last year. Talk to me about how that works and how that integrates with Section 179 and accelerated depreciation, and like, how do we navigate these things for tax?
Yeah, I mean, anytime you could take 100% depreciation in 1 year, it's a benefit, right? You're maximizing your deduction rather than spreading it out. If it's a 5-year depreciation, then it's 20%, right? Rather than 100%. So as these things phase out, you're going to be able to take less and less over time. The good thing is, like in 2023, if you missed out on it, right, you can still go back and amend your tax return for 3 years from the date of filing, or 2 years from the date the tax was due, whichever's later. So you can still file amended returns. So just these things that have expired in 21, 22, 23, they're not gone. If you do an analysis with the business owner, you decide whether there's enough meat on the bone to go for an amended return, you do that. But the Section 170, did I answer that question on that?
I think so, yes. Thank you.
179 in a second, but
yeah, no, that makes sense. How does it interact with 179?
Well, 179 allowed businesses to deduct, like in 2021, it was $1 million, $1,050,000. 2022 was $1,080,000, and 2023 it was 1.16 million that you could deduct for qualifying property expenses that you could take in the year that you made that purchase. So it applies to tangible personal property. Qualifying property includes newer used equipment, machinery, vehicles, computers, certain types of property used in manufacturing, production, transportation, And the deduction is available whether the equipment was purchased, leased, or financed. It's applicable to S corps and partnerships and other pass-through entities. It does phase out. Like in 2023, the amount is 1.16 million, but it starts to phase out up to 2.89 million, almost 2.9, almost 3 million. So it starts to phase, like that, the amount you could take starts to go down as you get closer to that. So if you had an investment that was close to 3 million, you take 1.16 off the top and you could deduct that, but the rest you couldn't.
Got it. Okay. All right, that makes sense. Tell me a little bit about let's dive into. I've got a handful of questions here that keep coming in around this section 174, which for those of you who don't know what this is, I'll set the stage because it's a bit it's a bit unfortunate. I don't think any of us expected this to happen, but Congress just failed to act. And so section 174 integrates in with R&D tax credits, which are section 41. So real quick for everybody, write down section 174, think R&D tax, R&D expenses, and section 41, R&D eligible tax credits. And they used to be essentially aligned. And so what people thought was, hey, this is great. We can take R&D and we can take it as a tax credit and we can use bonus depreciation or 179 to depreciate some of these things over time, or we just depreciate them as we go, but we can expense it. And what they said was that under 174, you have to actually capitalize these research and development costs instead of expensing them, which has caused a massive cash problem. Because if you take your R&D and it's $1 million and you used to be able to expense it in year one and you now have to capitalize it over a 5-year period of time, you're only deducting 200,000, but $1 million was put out. So you lost 800,000 in cash. So the first question that I got from the audience is do you think, Steve, that we're going to see 174 be changed back for small businesses anytime soon?
It's hard to tell. The winds of Congress are hard to predict. I think that there's, we thought it was going to be extended after 2022 and that didn't happen, right? So it really depends on, it's so hard to predict, Matt. I think, it's a crystal ball for my magic 8 ball for the Congress, I think is really tough. Whether 174 will be brought back, but it did hurt a lot of businesses. So there might be a lot of bad press. There might be some pressure on Congress to bring that back, extend it out to 2025, like the other provisions of the Tax and Jobs Act.
Well, and it really disproportionately affected small business.
It did.
Because our businesses, my business, businesses like ours, and small manufacturers are the ones who really got hurt by it, because then it really starts to think through, I guess, how you're going to plan out cash and how you're going to plan out purchases of new equipment. And maybe it's worth repairing something rather than buying something new so that you can expense it and not have to, go out and capitalize it. Maybe it's worth doing a bug on software rather than a whole new revamp. What have you seen? What kind of cash flow? How are you guiding your clients with regards to cash flow and business planning when it comes to this section 174?
Yeah, I mean, it's, for people on the phone who don't understand, I mean, putting it on the balance sheet, if you're having to capitalize it and put it on the balance sheet, you're not able to take the deduction, right? So it just hurts, or it's over many years. So I think for internally developed software, it's the amortization period's 5 years, but if you have any offshore folks, then it's 15 years. So it really changes the calculus on investment decisions. Okay, do we do this project now this year with that kind of rule, or not hire offshore folks, so we keep US folks, but they're more expensive, but the deduction will be a little bit higher, right? I mean, over 5 years instead of 15. So you're really having to evaluate the investment choices and the priorities and where businesses want to spend their capital to make sure that you're making a good decision, in terms of, just for the business, let alone for tax, right? So you got to think both, I want to put my book hat on and my tax hat on, with their CPA to make sure that they're making the right investment decision at the right time.
I find
there's a lot that goes into it.
Yeah, I find some of this, Steve, talk to me a little bit about the categorization, because I think, there's the gap letter of the law on how to do this, and then there's the practical application of how you put it into the books. I would love to know, is there a way that we can put things in so that that we're not getting stuck in this capitalization policy and we can expense it appropriately without flying, afoul of the IRS rules?
Yeah, well, I guess I would have to consult with a CPA to make sure that for the tax basis that, for book basis, we may be able to expense it, right?
Yeah.
And that's fine. And you could deduct it and, it goes against net income on your books. But for tax, I'd want to consult with the tax authorities to make sure that we're not running afoul of that, how we book it on the tax records.
Yeah, I know for us, and I'm just sharing this example because it really happened to me. In my 2022 taxes, I ended up having to not be able to deduct a large portion of our software development expenses. You know, Steve, we're developing a lot of software in the background to make our business owners' lives more efficient, helping, create financial statements and accounting statements faster.
Yeah.
And in 2023, what I was able to do, what my CPA told me I could do, was once the product was built, any kind of bug fixes and all that stuff could be expensed in that time. And so we internally made sure that we categorized all of those software costs as bug fixes and repairs. And that's really helped me for 2023. So I share that because I think there is a way for business owners to really think through what are they doing, how can they follow the rules, but make sure that they're descriptive enough with the way that they account for it so that they don't get stuck with a big cash problem. Because I was stuck with a big cash problem for my 2022 taxes, and I've tried to rectify that for 2023.
Yeah, no, that's a great point, Matt. Sorry, I just want to jump on that.
Yeah.
Part of the counts and how important that is, and understanding exactly what you're spending in the categories of expenses, because that detail makes a world of difference. Like you say, the bug fixes, the upgrades, the updates, like the enhancement things that you may have to capitalize, the other things you could expense. So that, having a chart of accounts that has all that detail and you're able to track that, you need, folks like TGG, myself, and teams to help identify that properly. So you give that information to the CPA and it's clear, what's capitalizable, what's deductible.
So that's great to hear. The other thing, Steve, that I would love, because I think it's a confusing topic, I'd love for you to kind of expand on is what's the difference between Section 174 and Section 41? And is there any benefit to R&D tax credits anymore?
Well, there's still tax credits available under Section 41.
Mm-hmm.
So, so realize that the tax 174 was changed such that you have to capitalize stuff instead of expense it in the year of acquisition. But there's still tax credits available under Section 41 for businesses that engage in qualified research activities. And it's like credit is generally based on the percentage of eligible research expenses that exceed a certain base amount. I don't have all the details. It's pretty high level, but it's things that create new or improved products, processes, software, or formulas through like experimentation and R&D stuff. It's very R&D focused. And the credit is for wages, it's suppliers, it's contract research expenses. They all qualify for this Section 41 tax credit. So
I think that's what's really an important thing to think about. The way that I like to think about this is in two circles. So the bigger circle is Section 174, where kind of everything gets bundled into there. And then the smaller circle potentially is Section 41, where you can get a tax credit. Well, if you have to capitalize all this stuff, you at least want to get a tax credit. So the way I think about it is from an accountant CFO standpoint, our job is to make sure that Section 41 bubble is the same size or bigger than the Section 174 bubble so that you actually get the tax credit dollars, because those are dollar for dollar reduction in tax. That's not a deduction, right? A credit is a dollar for dollar. That's a huge benefit. That's just like a dollar of profit. So I think it's really important that Section 41, I guess what I'm hearing you say is, hey, don't poo-poo the R&D tax credit. It's still there. And under Section 41, you might be able to take and recoup a lot of this cash that you otherwise might lose under Section 174.
Right, exactly. And if we, if it's helpful, we could talk about the difference between tax deduction and tax credit. I have an illustrative example, but we can do that later.
No, go ahead. Let's hear it.
You want to share it? Okay, yeah, I'll share it. So essentially, let's see, can you guys see my screen? Because if you can, then
Yeah,
everyone
no,
else can.
I can see it. It's great.
So here's tax deduction, tax credit. You have a $3,000 tax deduction and $3,000 tax credit. What's the difference? You have a $100,000 income, let's say, 12% tax rate. You'll owe 11, 3,000 minus 100 is 97. At 12% is 11.6, right? For a tax credit, same income, same tax rate. It's 100,000 times 12%, which is $12,000, minus $3,000, which is 9. So your tax savings is $26,000 tax credit versus a $3,000 tax deduction, because it's dollar for dollar right off the bottom. And if you have, if you don't have taxable income, if your tax is less than the credit, then you get a refund. So if the credit is more than what you owe on tax, you'll get a refund. So
you
that's
actually
what
can get the money back. You don't have to roll it into the next year or hold it back. You actually can get cash back.
you get cash back.
All
Yeah.
right.
So that's nice.
I took two things away from your illustration, Steve. Number one is we can get cash back, even if it takes us into a loss position, which is fantastic. And number two, I don't know who lives in a 12% tax bracket, but I want to.
I know. I know. Yes, that's true. Yeah, that's so.
Cool.
So the point of that is, like, if the tax bracket is higher, you get, yeah, it's even bigger benefit.
Oh, it's a bigger and bigger number. Yeah, no, I'm
Right.
teasing you. I was just joking about it because I think here in California we pay 12% in income tax.
Yeah,
Just at the state, regardless of what we've paid to the federal government. So,
yeah.
But I think that is an interesting one to think about. And it just brought me to an idea here. If all of these Trump tax laws expire in 2025, we know some of them expired in 2022, like Section 174. We know bonus depreciation started expiring in 23, and we know the estate tax exemption starts expiring in 24. In 2025, let's look at a silver lining. Do the state and local income taxes, do we get that deduction back, or is that gone too? Because all the income tax rates are going to go up, the estate tax rates are going up, everything's going up. Do we get some benefit in 2025 as well, or are we just all, going to pay?
Well, I think the SALT part, the state and local taxes were part of the tax law, so I think that would expire as well.
Yeah, so we've got.
But you have to look at your state. It's very different, right? Like every state has its own rules and limits. And like in California, I think there was no limit on the state side for, personal property tax, sales tax. There was no limit in California, like on the Fed, there was on the federal side, but on the state side, there wasn't. So it's important to talk to your CPA about the state you're in and the income tax potential, associated with these.
Yeah, a number of states have also come up with these regimes where you can actually deduct it through your business as a business expense, and the IRS actually granted that as eligible. It's going to be a massive mess to see what happens if this all unwinds in 2025. But I don't have a lot of faith, to be fair, in Congress at the moment. So we'll have to wait and see what happens.
And it's important to point out, like you said, Matt, that if Congress doesn't act, then we're going to go back to the old higher tax regime. Everything will be higher, right? The income tax, the personal exemption, like all that stuff's gonna. So that's why it's so important to be thinking about this stuff now, to know about it, and to start to plan so you can be prepared. So
one of the things that's very obvious to me is the capital gains rate. Right. That means that if you think you're going to sell your business in the next 2 or 3 years, you better make it the next 2 years and not the third, because there's potentially a 10% difference in tax there, a 10% rate difference, which is actually more like a 40% difference in the tax you'll pay. Right. What about income planning? I mean, they always say, if you're a cash basis tax filer, spend all the money you can before year end. It feels to me like you might want to do the opposite. If we ended up here in 2025 and this tax credits or tax laws are going to expire, wouldn't we want to pull income into a lower tax bracket?
Yeah, exactly. Yeah, we will. We'll want to pull income into those, into this world that we're in now, right? Pulling income forward if you can, and you could change your method from cash basis to accrual basis. You can make an election with the IRS and pull that, and make those adjustments into 23, 24, 25. while the brackets are lower. I put it in air quotes. It's not air quotes. They're actually lower.
Right.
You know, but after that, they're going to be back in the mid upper 30s. You know, so yes, bring that stuff forward as you can. Will have huge benefits. All these things we're talking about have massive impacts on your cash position for the business. It's huge.
Yeah, it's interesting. I've always believed you don't let the tax tail wag the dog.
Right. Yeah.
You know, the business has to go out and make money, just, you know, but there's a massive cash difference if we're not aware of these things. And what I continue to hear you say, and I think it's really important, is integration with the CPA. How do you evaluate whether your CPA is someone who, this is a question that I got, so I'm going to ask it now. It seems like an appropriate time. How do you evaluate whether your CPA is a tax preparer and about to be eliminated through ChatGPT or a tax planner? And how do you as a CFO interact with those CPAs?
Well, I had my CPA license for 18 years, so I come with a little pedigree, at least personally. I started my career in PricewaterhouseCoopers, and I had my license and let it lapse. But I mean, you want to make sure that you're working through us, who work with tax professionals who know the reputation of folks. I would be vetting them. I would go through an RFP process with my clients. If they don't have a CPA, I'd go through an RFP. We'd interview people. We'd ask important questions related to these kinds of things we're talking about to test their knowledge. And we'd pick the one with great referrals, with testimonials, with success. Like, that's kind of how I would navigate. Like I navigate with any supplier, strategic partner with my clients, is doing an RFP and making sure that we're meeting the client's goals and we're doing a good bidding process, not just picking somebody, Bob down the street, right? He knows somebody. Like that may work out, but you might want to cast a wider net and see what's out there. There may be very specialists in your business area, your manufacturing or biotech or a SaaS company, right? There may be people with specific state knowledge, that's really important for the state you're in. So that's the kind of profile I would take in terms of getting, helping out my clients for hiring a CPA.
Great. Have you ever seen any bad advice from your, this was another question that just came out of the audience. How do you spot bad advice?
Well, I think that you have to kind of have a healthy skepticism with anything you get and make sure that you're having a clear head and clear mind. Does this make sense, right? Does it pass the sniff test? So I don't think I've had a specific situation that I can recall, but I'm always, like, as a former auditor at a Big Four firm, like I always have this healthy skepticism about the information that's coming to me, and I want to verify. It's kind of a trust but verify type thing.
Yeah.
And so I have a very tight lens in terms of making sure that this makes sense. And it's not something that's being, scammed. I'll research it myself. Like,
Sure.
There's like all kinds of tools out there. There's my background, 30 years in the industry, like, so you can ferret this stuff out. So that's how
I think that's important. I think it's important to have a CFO help you ferret it out. My belief is that we should be providing financials to CPAs at least quarterly, so that they can help our clients proactively plan for their income tax issues and plan to minimize the income tax burden as much as possible. But I've also seen a handful of CPAs get a little too aggressive. And for example, I just dealt with an issue on the employee retention tax credits, where a CPA, we did all the math and the client just flat out did not qualify for these. And the CPA was taking a fee for getting these things and getting a success fee for how much they got for them. And the client went with them. And now the IRS has put a moratorium on paying them. And in fact, has a voluntary repayment program. And if you don't voluntarily pay, they're going to come after you. Like, holy moly. Can you talk to me a little bit about, because I feel like this ERTC is just a landscape filled with scam artists, and yet that's such a huge credit. If you qualify, like, you got to go get it. So how do you weed through this, Steve?
Well, we have people that we work with, experts that know the ERTC really well. It's the employee retention, just to level set people, it's the employee retention tax credit. It's essentially a refund of your payroll tax for 2020, from March of 2020 to September of 2021. And in 2020, you could get like $5,000 per employee, per quarter, but it went up to $7,000 per employee per quarter in 2021. So you're right, it's massive. And there are a lot of scams out there, but we're working with a couple of my clients. I'm working with an expert that's looking at the revenue test, the facts and circumstances test, and we're not going to go for it if it's not something that we think that is I guess is defensible with the IRS, because the IRS could claw it back, and they could hit you. So you got to be careful. And the refunds won't be like this particular consultant we're working with doesn't get paid until the business gets paid, and that's maybe 6-9 months from now. So you have to do a careful analysis. You have to make sure that on the revenue test, your revenues went down 20%. If your revenue, from 2019 is a base year, if you're doing it based on facts and circumstances, then you have to make sure that your revenue might have stayed steady, but there are things that you had to incur. There are costs you had to incur in order to stay in business. Like think of a restaurant that had to invest in outdoor dining, all that stuff, right, to maintain their client base. Things like that are harder to qualify under the IRS guidelines, the facts and circumstances, than the pure revenue decline. That's clear.
Right.
Like in 2020 for COVID, right? 2021, our revenues tanked compared to 2019. You have a pretty good case. It's those edge cases that talk about the facts and circumstances that people can get aggressive. And like you say, the scam artists are out there, and you just have to be careful. You have to work with us. We have clear eyes on financial data and information, and we will help you avoid scams. I wouldn't answer any email, that you get, any solicitation email. I think that's risky. I would talk to your TGG friends to help you.
Yeah. Do you ask your CPA experts of the ERTC, do they have insurance for this kind of stuff? Like, can our clients make sure that if for some reason the IRS comes back, that they're insured somehow against, because I get worried about penalties, interest, that kind of stuff.
Yeah, that's a great question. I'll have to ask when working with this expert if they have insurance if something goes south. I'm sure they have business insurance in order. The person that I'm working with has done 500 of these. It's kind of the national leader in this space. And so I'm sure of it, Matt, but I would want to verify, with him before
I would just want to make sure. I think if for me, like, I don't want to pay somebody. I get paid, call it $150,000, and the person promoting the ERTC takes $50,000, $30,000, and then they're gone. And then 3 years from now, the IRS comes knocking on my door and I owe money. I want to make sure these are reputable firms that are staying around, that have insurance, that all these kind of things.
Right.
So, I get a little nervous. There's been so much fraud, whether it was with the PPP loans or the ERTC or the EIDL loan. There's just so much fraud out there when the government just gave out this money, and I want to make sure that our clients are thoughtful, and the people, especially on this, are thoughtful around doing it, but doing it right.
Yeah, because of all the fraud associated with PPP, the IRS has its sights up, right? I mean, they're aware that there may be other scammers out there, so they are looking at it closely. But that's why you need experts to help you navigate and make sure that it's really viable, and then the business owner would decide, should I take, like there may be some risk, right? And then we can help guide them through that. Like there's a low risk, a medium risk, a high risk, and they could decide, and we would advise.
Sure.
So,
all right, let's pivot a little bit. That was, I think it's an important topical discussion because a lot of people are in it, but there was a lot of also opportunity here that I want to talk about. It was created by Biden's Inflation Reduction Act, which is the weirdest title of it did nothing to reduce inflation. In fact, probably the opposite, but it did have a lot of green energy tax credits, and one of the biggest ones was this investment tax credit. Can you talk a little bit about what is the investment tax credit How does it work and how do you qualify for it?
Yeah, I've got a whole list of all the different credits on this. There's so much, but it's basically a tax incentive designed to encourage businesses to invest in renewable energy projects, clean energy, right? Solar energy systems, wind turbines, fuel cells, geothermal systems, like um, certain combined heat and power systems. It's 30% of qualifying expenses. I'm putting solar on my house this year, Matt, because I'm getting a 30% tax break,
Yeah.
credit, 30% tax credit. Remember, we talked about that. So if I have a $50,000 project, it's $15,000 that I'm going to be able to deduct, um, not deduct, but get as a credit from my taxes, which is massive.
Yeah.
So the Inflation Reduction Act extended the ITC from 2022 to 2032, unless it gets repealed, right? But it's the cost of equipment, its installation. It doesn't cover land or other non-energy property. There's the residential component I talked about for solar PV cells and equipment that uses solar energy. But there's all kinds of, like in the IRA, the Inflation Reduction Act, we can send you guys a link. There's 24 different tax credits for clean energy, clean manufacturing, um, all kinds of stuff that I can pop up and we can look at real quick. But all kinds of programs that you didn't think you might qualify for, but you might. Like if you put solar on your building, I have a client that did that. Obviously, they're going to have a credit.
Yeah.
But even if you have a energy efficient refrigerator for your break room in your business, you can get a credit for that. Like there's so many things that are eligible. You've got to look at this list. You've got to work with us to help you not, navigate that stuff.
Well,
So
and again, making sure that you understand the difference between a credit and a deduction, because that credit, even at 12%, is a is a large dollar. So I think really understanding this is really important. The other thing that came out here was this IRS code section 127, which is these educational assistant programs. This actually came out, I think, of the COVID relief plan. I don't remember
yeah,
which one of the bills it was. But we use it here at TGG, where we give $5,200 for our employees. And by the way, it's income tax free to them, it's payroll tax free, and it's deductible for us
yeah,
for student loan repayments.
yep.
And for us, it's not just an added benefit on top, but you can use it as a salary reduction. So you can actually do it both ways. It's not a new cost to the business. What are you seeing? Can you give me are you seeing your clients use this? If not, why not? If so, where are you seeing it used?
I think most of the clients may not be, there's so much, tax law is complex, that changes every year. There's so many things, it's mind blowing how much there is. So a lot of the clients I have aren't aware of it, right? So they're reimbursed. I have a client that reimbursing their assistant controller for classes she's taking to get her certification. And they didn't realize that they could deduct, that they have a deduction for this under IRS code section 127. They're actually an ESOP, so they're not subject to federal taxes, but state taxes, they can deduct this under the EAP, Educational Assistance Program. It's 5,250, like you said, Matt, and it's a huge win. And I guess what I'm coming across is that the clients don't have a full landscape of the tax laws, like all the things available to them. Like they may be doing good things. They may hire a veteran and not know they have a benefit for that. They may be
Yeah.
doing low income housing or rehab stuff, or they may be paying their employees for reimbursing them their education, like you just said, and they're
Yeah.
not realizing that they can deduct that stuff. So it's helping them, us knowing all the rules, and then navigating, say, okay, understanding their business intimately, and then applying these things uh,
Sure.
to that.
Well, I know there's another, I think there were 8 other tax credits
Yeah,
that came out with this stuff. I think one of them that I think was a really interesting one that I'm not sure many people are using is this work opportunity tax credit. Can you tell me a little bit about this work opportunity tax credit? What is that?
yeah,
Wow, you've got okay, never mind. You got something on all of them. Let's
yeah. No,
dive into
thank
them.
you.
Tell me
I
what we
already
got.
pulled this up. Thank you, Aubrey. I'll walk through some of these, and if anybody on the phone has an interest in knowing more about these, but I'll talk about the work opportunity tax credit first. But there's
Sure.
all these other ones.
Yeah.
So work opportunity tax credit, it provides tax credit to employers who hire individuals from certain target groups facing barriers to employment, like the long-term unemployed, ex-felons, veterans, like I mentioned earlier. So if you're hiring people that from these certain target groups that are harder to get into the job market, you're going to get a tax credit from the government for
Yeah, I
doing it.
remember this, and veterans seems to be like the obvious choice. But I mean, how many people on this Zoom have hired veterans and not taken advantage of this? I think this is another one that we've got to be really mindful of, because this is a credit. It's a dollar for dollar reduction or in your tax, or increase to your cash flow, or increase to your profits. So that's great.
Yeah, yeah, exactly. Some of the other ones, I think that, to point out the low income housing credit, it wants these are incentives to try to spur investment in low income housing, affordable housing, rental housing for low income individuals and families, trying to be good citizens. So this credit is available for those types of, investments. Historic rehab tax credit, right? Like tax incentives for rehabbing certain certified historical structures within your town or city. Doing stuff like that, you can get a tax credit for. So one thing that was new to me was this new markets tax credit. So it's intended to stimulate investment in low-income communities by providing tax credits to investors who make qualified equity investments in community development entities. So it's just supporting growth in a community.
Yeah.
And so they're trying to incent all kinds of behavior to help low income, help veterans, help disadvantaged people, help historic buildings, help clean energy. Like anything you're doing for the common good, I think you could get a credit for it. And then there's small business credit, provide health insurance coverage to employees. So for businesses that provide health insurance coverage to employees, you can get a credit for that.
Sure.
By providing health insurance to your employees, they're giving you credit.
I think the other one here that I've seen, Steve, that's on here is your child independent care credit. This is something that I'm not sure people fully appreciate, but I think it's really important to understand is we've got this trend that has really overwhelmed our society of work from anywhere, work from home, work from part-time, part-time in the office, part-time not. And a lot of people, have child independent care issues because during COVID, they didn't. Now they're working from home. And now if it's part-time, one of the things that I have seen work really well with a client that we've got is they offered, $1,000 a month per child or per family or per head. And this is a credit that actually can make you money, where even though you're spending it and you're giving a benefit to your employees, you can actually turn out making money because on the tax savings, you've got such a big dollar amount that at the end of the day, you can structure it with your employees in a way that benefits them and benefits you in a massive way. I've seen this one in particular work out really, really well. And I would encourage people who are on the line here today to think about their employee base, and do their employee base have kids? And is this a challenge for them? And can they help the employees with this challenge and in turn get themselves a big tax credit?
Yeah, the credit ranges from 20% to 35%. So, I mean, if you've got a daycare facility that you set up at your office, or you pay health, daycare child services for your employees, I mean, the credit is 20 to 35% of that cost, which is,
It can be massive.
It's huge. Yeah.
Yeah. And again, non-taxable issues. It's still a deductible expense, no payroll taxes, all those kind of things. Cool. Well, this is great. I've got a bunch of questions that have come through. So let's dive into these. These are some of these things we missed here and I think people want us to come back to them. So let me get into some of these things. The first one is, if you don't own the building, then how can you benefit from solar roof installation? This is a good question. I'd love to hear your thoughts on that, Steve.
Well, in the case of the example that I brought up, the client does own the building. And so they own the building, and they're managing and leading the solar project. If you don't own the building, then you'd have to work with, the building owner. Like if you were going to participate as a partner to put up solar for the benefit of your office, maybe there's a partnership that you could work out where you want to, you're passionate about solar and PV and clean energy, and you want to participate. You could do it that way. That's how I would think about it. If you don't own the building.
Yeah, the way I was thinking about it is you've got to think about your lease. So it's really an important thing to go back to your lease and what does your lease look like. If your lease includes common area maintenance charges or is a triple net lease where you're paying the energy directly, you could get permission from the building owner to put solar on the building. You could still own that solar. So when you move out of that building, you can actually take it with you. In theory, you could lower your electricity costs and get the credit. So there is a reason why it might make sense, even if you don't own the building. That said, I would love to just also say that the SBA loans are still in the 5.5% for those who qualify for owner-occupied buildings, where you can buy a building here for 5% down as long as you occupy more than 51% of it. This is still an enormous opportunity for people to go out and buy their own buildings, particularly now in this real estate market that is kind of depressed in a lot of these ways.
Yeah.
On that same solar, I want you to touch on this one real quick, Steve, because this was something that you mentioned. If we use part of our home as our office, can we get solar installed and take the credit?
Yeah, I think you can. I'm pretty sure that you can, because the IRS looks at the square footage of the space you're using for your office, and you could deduct the expenses associated with that office. So that's anything associated with the cell phone, the power, all the things. You can allocate some of those costs for maintaining that office, and then the investment in solar could be part of that you could fold into that. That's what I think. You'd want to probably check for sure with your CPA professional, but
double check. But that's the way it reads.
That's kind of the way it reads to me.
Yeah.
But I love that thought about the solar, that it's in the lease and you could take it with you. That's a great point.
Yeah.
And I'm going to bring that up with other clients of mine.
All right. I'm going to try to get to all these here as we're moving a little quickly. I don't hear anything about retail stores. Are there different rules for selling retail versus a distribution versus a service business? I added those differences in there. I'm trying to interpret the question, thinking of doing so in the next year or two. If we're selling a retail business, is that different than because of the inventory? I'm guessing is what the question is.
Yeah, I'm trying to maybe understand what
I think the question is around the sunsetting of the capital gains tax issues. Meaning, do we need to accelerate it because it's a retail business, or are all these businesses essentially going to be the same?
That's the latter is kind of what I think.
Okay.
But it has to make sense when you think about your inventory and having to, what are you going to do with that? You're going to write it off, or what's how much do you have? Are you going to be able to sell that? There's considerations obviously for warehouses and storing that stuff, and the inventory pieces that are a little bit more complex. But
yeah,
I mean, capital gains applies to any industry, any business.
Yeah, I think there's a really interesting component here to understanding how your business might be purchased. Is it an asset sale versus a stock sale? If it's a stock sale, there's not going to be any difference at all. But if it's an asset sale, which most small businesses are purchased on asset sales, you got a very big difference in potential income tax, as well as a potential difference in certain states with sales tax that you've got to be really mindful of. And that's not just for retail, that's for any personal property. For example, in California, that is transferred as sales taxes out on it. So, yeah, I mean, if they're not going to tax you one place, Steve, they're going to find another place to tax you. This is why we got to use these credits, right? So a couple of things here that I think are important. What are your thoughts on the delayed notice vote on early RTC ending R&D changes this past Monday? So there was a vote that just happened on Monday. Did you see this, Steve? And
I knew that on today that the Congress could say you can't file any more ERTCs, but I don't know if that happened.
But it didn't happen officially. Okay.
What's that?
So it didn't happen officially. It was in committee, and Congress has not passed it. The president hasn't signed it. But there is a movement afoot, and it'll tell you how much fraud is in the ERTC, really, because there is a lot of pressure on Congress to stop this program immediately. And so what I think this highlights is that this potential bill said the last day to file would be January 31st today.
Right, today.
I find it really hard to believe that they could pass a law after January 1st that goes back to January 31st. But we'll have to wait and see. I think the real point in this is that if you think you might qualify for the ERTC, get on it now.
Yep.
Don't wait. Don't
That's
wait
right.
and let it kind of, continue to move.
That's what we're doing. Yeah, with the clients I'm working with, we're moving quickly to see if we should try to get it in before the deadline.
Yeah.
If that happens. But like you said, can they act that fast? Can Congress act efficiently? I haven't seen it.
Yeah, I haven't either. So here's the other thing that I'd like to just chat about, because I see it there's 3 questions about it in our question list. The moratorium. So have you seen anything that there's a deadline as to when this moratorium is going to get lifted on payments for ERTC?
Not familiar with the moratorium on
this was something that the IRS commissioner spoke to Congress earlier this year. It was early in January, and stated very clearly that the IRS has no definitive timetable for ending its moratorium on processing ERC claims received on or after September 14th. So anything that was September 2023, anything before September 14th, 2023 is still going to be processed. But if it was after September 14th, 2023, it's a moratorium on processing any of them. So I think it's important to understand that this is not cash that you can count on 100% if you filed after September 14th. And even if you didn't, I've heard a lot of anecdotal stories about people having to wait a long time to get their checks. It's the government. They're not moving fast. So
yeah, what that reminds me, now that you bring that up, when I was talking to the expert, he did say what that's doing is just stacking it up, right? So that's why, I mean, so they're accepting those filings after September 14th of 2023, but they're not getting to them very quickly. It's just stacking up, right? And they have to get through that backlog, and that's why the credits are 6-9 months from now. So that's what's happening. So the moratorium was like, we're just overwhelmed and we've got to get through the backlog. We're going to accept it, but it's not officially dead. But
but I think the ERC is on its last legs. Again, I think that the tide is moving, that Congress wants to get this thing out and move away from it. They just see a lot of abuse, a lot of stuff that they're trying to. So again, I think the thing for everybody to think of is, if you're after September 14th, your chance of getting the money anytime soon is very small. Even before, it's probably extended. And then if you think you qualify, really test it hard, make sure you get a good professional and get in there and do it now, because there's a good chance that this window is going to be closed and gone forever if you don't do it now. So I think those are my key takeaways. Is that what you see, Steve?
Yeah, I think Congress will give some grace period. They won't cut it off on 131. I just don't see that happening. I think there'll be some 30, 60-day window.
It'd be hard for me to see them pass something after today and bring it back to the 31st. But again, we've seen Congress do some pretty stupid things in the past. I'm not going to put it past them. All right, a couple positive ones here before we finish. What's the difference between the work opportunity tax credit and the empowerment zone tax credit? This is a good question from our audience.
Okay, so the work opportunity is, hiring disadvantaged folks like veterans, long-term unemployed, and ex-felons and stuff like that. Empowerment zone is for businesses located in certain designated empowerment zones. There's wage credits and increased expenses for qualifying property. So you'd have to look at what is defined as a designated empowerment zone to see if you qualify. But it's different. It's not like empowerment of people. It's empowerment of
the actual zone.
Yeah.
I think if I remember correctly, you can actually look online. There are several places where you can look and see what zip codes actually qualify for empowerment zones. And I think there are 2 components to it. One is wage credits for hiring people that live in those areas. And 2 is actually a credit for buying property in those areas. Is that the way you understand it?
That's
the empowerment zone credit. That's hiring people from a certain area versus the work opportunity credit, which is hiring a certain type of person, someone who's been out of work for a while, like you said, ex-felons, which you obviously want to be very careful with. What I really love is veterans and former military.
Yeah.
Those folks qualify for this work opportunity tax credit and are really a great opportunity for our clients as well.
All day long. We give back to our veterans. That's huge. I completely support that too. Yeah.
Yeah, absolutely. All right. So lots of stuff here that we've gone through today. What if we've got to leave here with everybody getting kind of big takeaways, Steve? What are the things that you'd like them to leave with?
Well, I think knowledge is power, right? Understanding about these things and this is step one, is to be informed, right? And then I think taking the next step is, trying to work with us or work with your CPA, tax professionals to really understand your business. What TGG is, what our core competency is clean, accurate financial statements in accordance with GAAP. I mean, we provide a financial package that your tax CPA will just adore. They'll love you. It'll be clean. You'll have a chart of accounts that will, for all the different, like meals and entertainment, 50 meals and entertainment, 100%, meals and entertainment, 50%, like all the different categories of investments and costs so that the CPA can understand it. And that will lead to a more accurate tax bill, a lower tax bill. Like they won't charge you as much because your books and records are clean. But as CFOs, we understand our clients' businesses intimately. We understand their goals intimately. We know the right questions to ask. And so we are your source to help navigate this very complex area. Starting with our core competency, which is amazingly accurate, timely financial statements. That's our bread and butter. But our relationships we're like partners with the business owners to help make sure that we're meeting their goals and they're doing the right kind of planning for this, particularly in tax, for what we talked about today, but we do lots of other things for the clients to meet their goals, financial goals. So
yeah, I look, I agree. What I heard you say is complexity and teamwork. You got to have a good CPA who really is a planner. You got to be careful not to get away from the scammers. And you got to make sure that you're you've got good financial information to start with, which is obviously what we really preach and promote. Steve, I want to thank you a ton for being here, providing your expertise and wisdom to everybody. I hope everybody got some good takeaways. I think we got to all or nearly all of the Q&A. If anything else comes up, everybody please reach out to me. You've got my email address. Steve's was in this. And Aubrey, as always, thank you for setting it up. We really appreciate all of your work behind the scenes for making these things happen. This was a lot of fun. I learned a lot. So thanks, Steve. Thank you, Aubrey. And we'll see you guys next time on the next Bonfire Chat.
Thank you, Matt. Thank you, Aubrey. Thanks, everyone.
Thank you.